Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
We do also want to check in on geopolitics. There's a lot going on. You heard certainly Joe and Kayleigh talking about some of it on the U.S. side, but as we broaden it out, there are a lot of things going on. Among them, U.S. President Joe Biden criticizing the extent of Israel's military campaign in Gaza as tension builds over Israeli plans to push into Rafah, where more than 1 million people have sought refuge. He made, the president, making the comments last night in a wide-ranging press conference at the White House. Here's what he had to say.
The conduct of the response in Gaza, in the Gaza Strip, has been over the top. I talked to Bibi to open the gate on the Israeli side. I've been pushing really hard to get humanitarian assistance into Gaza.
That was, of course, U.S. President Joe Biden criticizing the extent of Israel's military campaign in Gaza. That was last night at the White House. The president's comments marked an escalation in his criticism of Prime Minister Benjamin Netanyahu's prosecution of the war against Hamas. For more, we turn now to Marc Champion. He's a Bloomberg Opinion International Affairs columnist. He joins us on Zoom in London. Marc, we want to go around the world with you, but we do want to start in Israel this afternoon. The significance of President Biden coming out and saying this, it certainly seems like he's continuing on a path of becoming more critical of Israel. What did you make of it?
Yeah, it's he's been on a bit of a trajectory where he began after October 7 saying we are with you no matter what, but as the casualties and the destruction in Gaza have increased, you've seen that an increasingly cautious tone creep in, with a lot of focus on trying first of all to get aid in, and then to get focus on getting the hostages out, and increasingly a focus on getting a pause, a truce in the fighting. And at the there are negotiations continuing, although we don't seem to be very close at the moment. There's certainly nothing imminent. So yes, this is another step up. At the same time, he hasn't said anything about restricting arms sales to Israel or anything of that sort. So nothing really substantive has changed yet.
Right. Kind of guns speaking louder than words. And I do think about that, right, Marc, in terms of whether it's support of Israel or whether it's support of Ukraine, what the U.S. does says a lot about their policy. Is that a fair conclusion?
Yeah, absolutely. It is critical. Probably the thing is that Israel, the conflict in Gaza is on a different scale, and the opponent is on a totally different scale from what Ukraine faces in Russia. So, Israel can get by without a lot of military aid being, additional aid being pumped in from the U.S. With Ukraine, that's a whole different ballgame.
Well, let's stick with Israel for one more minute and talk more about the future of what happens in the Gaza Strip. I mean, with President Biden speaking like this, is there a chance that Israel does scale back what it's doing?
We haven't seen any sign so far that Netanyahu is very receptive to these kinds of nudges and hints. He has done some things that the U.S. wanted. He has, he did have a 7-day pause earlier on in the conflict. He did get more aid in at a time when there was virtually nothing getting in. So the U.S. has had some impact, but it's relatively limited. And I think there's a lot of concern now because they're really, once you move on Rafah, which is right on the Egyptian border. It is the place where people, would be able to get out if the border was opened. Once you move on there, there's really nowhere left for, the people of Gaza to go. And I think that is where the concern is. Egypt's now extremely concerned that this could end up with people just storming the border to get out of Gaza and get to safety on the Egyptian side of the border with it, which they are very, very determined not to have happen.
Hey, Marc, as you just noted a moment ago, the scale and risk of what faces Israel versus what faces Ukraine, it's different. And I want to go there a little bit more deeper in terms of Ukraine versus Russia right now. Russian Vladimir Putin giving an interview to Tucker Carlson. It's very clear what his intentions are here, correct? You write about this in a Bloomberg Opinion column.
Yeah, absolutely. I mean, this was a great opportunity for Putin, gifted to him by Tucker Carlson. He got to talk for well over 2 hours and to reach a big audience in the United States, a receptive audience in general. And he was able to set out, all of his narrative about, why he's in Ukraine, why he did it, what the implications are for the United States, what he thinks the United States should do and the Europeans should do, etc. And so this was quite valuable for him. How much impact it will have in the end, I don't know. But he got more than 2 hours to speak and didn't really get any hard questions or any pushback of any sort.
Did you learn anything about Vladimir Putin or Russia's intentions in that interview, Marc? You followed the conflict in the region very closely for years.
Yeah, no, there was really nothing new here for anybody who follows the conflict closely. What I found interesting was the way in which Putin approached it. So when Tucker Carlson asked him a sort of a very leading question, saying, you thought that you had to invade Ukraine in February 2022 because you thought the United States might be coming to attack you in Russia. So why did you think that? And Putin essentially just ignored that question, which you would have thought was a lob where he could then, come back and say, yes, we were forced to do this by NATO, etc. It's a theme that he's, would come back to in the interview, and he's talked about, endlessly. But he spent the next half an hour in basically a monologue on Russian-Ukrainian history and describing why it is that in his view, Ukraine is not a country, and why it is that much of the territory that's currently Ukraine, he believes is in fact Russia. So that to me was quite telling. And I think, for people who don't follow it very closely and hear all this stuff about, how NATO pushed him to do it, I think that was actually quite worth listening to.
I mean, this is bottom line, Marc, right, about territorial conquest for Russian President Vladimir Putin. Again, there are, I think, folks sometimes who are far away from it. They're not over in Europe and think, okay, how does this impact me? Although we know that there's been some impact. Certainly, we've talked about it in terms of companies and other issues in terms of the markets. But having said that, you do wonder if ultimately President Putin wins here, then what's next, correct? And just got about 30, 40 seconds here.
Yeah, absolutely. I mean, he was asked that by Carlson, and he came back and said, it's ridiculous. Why would I, try to go into the Baltic states or anywhere else? This is unique. But unfortunately, he has a long, long history of saying, I'm not going to do stuff. I'm not going to annex Crimea. I'm not going to, go here or there. I'm not going to invade Ukraine. And then he does it. So, I think one needs to exercise caution. Well,
as you noted, a comment about fact-checking, a full fact check of the interview would take several columns. So it's important, right, that we understand exactly what's going on, and your insight, so appreciated. Marc Champion, again with us, international affairs columnist at Bloomberg Opinion. Check out his column on the Bloomberg and at Bloomberg.com/opinion. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
'Tis the season, tax season, and a big player in the space, H&R Block, reported earnings this past week on Wednesday. Shares, though, did fall nearly 11%, their biggest intraday drop since the onset of the pandemic in March of 2020, after the company reported second quarter results. The stock, though, I should point out, by the way, gaining 32% last year, is off 3% year to date. It's up about 3% today, and it did finish off its lows on Wednesday. So we're delighted to actually get into the business with Jeff Jones once again. again, President and CEO of H&R Block, on Zoom from Kansas City, Missouri. Or should I say Missouri, because it's so clear in your red sweatshirt, if you will, who you are rooting for. I was going to say that till the end, Jeff, but it's nice to be transparent and get it out there. I guess you're excited about the game.
It's Chiefs Friday in Kansas City, Carol.
Understand. Hey, listen, how are you? Talk to us a little bit about the business and what you guys saw last quarter and how things are evolving into the current quarter.
Yeah, no, great commentary to open. We had a really strong Q2. We're off to a great start to our fiscal year, and we're really seeing growth in all facets of the business. Small business tax, we had a really nice extension filing season. Our Emerald Advance product performed very well, which actually speaks to some of the macroeconomic needs of the consumer. And our Spruce product is performing well. So the stock's kind of made almost a round trip since we announced on Wednesday, but we're feeling really well positioned for our Super Bowl season, which is tax season.
Well, we'll get into some of the products, because there might be some folks who are listening who are like, I'm not familiar with the Emerald Advanced product, but that's where you guys essentially give some loans, right, in advance of a file. Give us a little bit more on that color and what that tells you about maybe what's going on more broadly among Main Street consumers, individuals, and their financial health.
Absolutely. So our Emerald Advance product is a short-term loan that we offer to consumers in the holiday shopping season. So last fall in our Q2, we saw a 25% increase in loan volume this year. And so, we've talked so many times together about recession. Is it happening? Is it not? How's the consumer? But when we see the consumer seeking these products, it really speaks to the fact that in an everyday life kind of way, they are in need of cash. And that's the role that the Emerald Advance product plays.
Jeff, give us some more insight and color there, because we're right now flirting with records again on the S&P 500. The economic data continues to come in very strong. We know there are more jobs out there than people who are looking for jobs right now. The unemployment rate is sub 4%. Does that not match with what you're seeing from your customers?
This is the irony I think we've all been trying to contend with now for several years. I mean, I'm starting to believe that these broad labels we have about inflation or economy, even we see middle America, they're just too broad to speak to the everyday reality of consumers. And so I don't dispute all of that economic data that we see, but we serve 20 million people a year, hardworking Americans. We sit across a desk from them, or they use our software product. And when we see things like taking an Emerald Advance loan at a substantially higher rate, or we're in the season now for refund advances, or how quickly do people file their tax return, those are all very tangible indications that the consumer needs cash.
Well,
so I think we.
Oh, go ahead.
Please.
No, Jeff, please finish.
I was just going to say, I think, we're learning that you can look at macro indicators, and those certainly provide direction from a company perspective, but every single day, how the consumer is needing cash, where they're spending it. We put out this report last fall called The Outlook on American Life. And this gave us really deep insight about middle America. And the first thing we learned was there isn't one middle America. We saw a Gen Z and a millennial middle America, and we saw the boomer middle America. Very different attitudes and mindsets toward jobs and wage growth and employment, more millennials than ever getting a second job. So yes, we have to pay attention to the macro, but obviously we see our customer behavior every single day.
It's why we like talking to you, because we dig down. You mentioned the Emerald Advance product, so loans up 25% you saw in loan revenue. The Spruce product, right, that allows somebody to get access to their paycheck, right, a couple days earlier. Are you also seeing an uptick in that use?
Spruce is really off to a nice start this year. And, there are several things about Spruce that I think are what's resonating. Remember, this product, it's only its second year in market. And so, we're offering the consumer to get their federal tax refund up to 6 days early when they deposit it on Spruce. So timing really matters. Very low or no fees on the product. a chance to learn about credit, a chance to build savings. So we're really positioning Spruce as a way to help the hardworking American be better with their money. And we're seeing the early signs of that really starting to resonate.
Jeff, you also serve small business owners, small businesses, so you have some good insight there. We like to talk to you about that. Give us an update on what you're seeing, because we know that small businesses account for 2 out of every 3 jobs that have been added in the past 25 years. What can you tell us about the small business community?
Incredibly resilient, incredibly creative. You know, this is the backbone of America. It's why it's so important to us that we serve them the way we do. Our small business tax revenue was up 20% in the quarter. And so we're absolutely seeing small businesses, you know, in many ways they are consumers. We're talking specifically at Block, small businesses, 9 employees or smaller. And so they've had to make shifts in how they think about selling and digitizing their business. Obviously, they're dealing with regulations about, you know, how they deal with their business. But the small business mindset and the small business starts, we continue to see very strong.
That's what I wanted to ask you, what you're seeing in terms of small business creation. You're seeing it more to the upside versus those shutting their doors?
We are, absolutely. And obviously, you know, many small businesses don't make it to their first year, but this is the entrepreneurial spirit of America. And when the labor market changes, we see more people create starts. And so we are seeing that. Remember, too, that from a tax perspective, if you're a consumer, but you have a side hustle, which more and more Americans are doing as a second job, you know, that's a small business to H&R Block because they file what we call the Schedule C. So we're seeing a lot of growth in the schedules.
Net, 30 seconds left here, Jeff. Recession, what are the words you use to describe the environment right now? You run a business, are you hiring? How do you describe it? And just real quickly, if you could.
We do not see recession. We know we have to get beyond the broad labels and manage the business in a local level. That's what we're focused on. But the consumer is resilient despite some of these pressures. They always find a way.
Are you hiring?
We are hiring. Yes, our business, we feel very good about how we're positioned. We have a lot of great jobs in AI and engineering and cloud.
Okay.
So absolutely, we're hiring.
And are you a fan of Taylor Swift? That's what we need to know.
Who cannot be a fan of Taylor Swift? But definitely a Chiefs fan.
All right, Jeff Jones, good to check in with you. President and CEO of H&R Block on Zoom from Kansas City, Missouri. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, so we said S&P 5,000, a very round number. Right now we're at 5,022 on the S&P. Charlie, of course, just breaking down the markets. It's a very round one. It's one that we market watchers and market technicians, I would say, Tim, safe to say, like to keep an eye on.
Yeah, the S&P 500 index on track to finish above that number for the first time ever today. It did it briefly. Right at the close, touch 5,000.
Touch and go,
did not
man.
close there. Yeah, it was 700. Okay, so here's some stats that you put together, Carol. I love this. It took 719 sessions for the index to set its latest 1,000 point milestone, much shorter than the 1,227 trading days it needed to get from 2,000 back in 2014 to 3,000 in 2019. That's according to data compiled by Bloomberg. It's nothing compared to the 4,168 sessions to get from 1,000 back in 1998 to 2,000 in 2014. A lot of that has to do with, I mean, when you go from 1,000 to 2,000, you're doubling. Okay. Yeah. When you go from 4,000 to 5,000, you're increasing by 25%.
No, you're absolutely right. So with what it means technically, if anything, of S&P above 5,000. Back with us is Ryan Detrick, Chief Market Strategist at the Carson Group on Zoom from Cincinnati. As we mentioned earlier, the market technician who nailed last year's rally. So we wanted to know what he thought about this milestone on the S&P 500. Ryan, good to have you back with Tim and myself. So what do you make of this level? Is there something significant in it for you?
Yeah, Carol and Tim, thanks for having me back. But, you know, one more for you. When it cracked 100 was in 1968. That took 40 years from 1960, or 30 years, sorry. Yeah, it was 40 years, yeah, to get from, 100 to 1,000. So think about that. But nonetheless, let's get into this. What does 5,000 mean? On the surface, Not a whole lot. We know that. But psychologically is really what matters, I think, for investors. And the big question, of course, is, okay, when you look at 1,000, 2,000, 3,000, 4,000, which I did, what happens next when you cross these psychological levels? Well, listen, 6 months later, S&P has never been lower, up like 8% on average, almost double the at any time returns of about 4%. So long-winded way of saying, hey, making new highs, came on with you guys a while last year saying when you're making new highs, it tends to lead to more new highs. Eventually, we'll hit the final new high. We know that. We just don't think we're there yet. And we think this is a pretty strong sign that, hey, we're still in a bull market. We've said that for a while. And, just get on the ride. It's a fun ride.
What's the sign that tells you it is the final new high?
Yeah, well, maybe like when your grandma calls you up and says, "Let's buy something," right? I think that's the worry. But
that's so
listen,
funny, Peter Atwater, who we have on the program a lot down at William and Mary, he wrote the Confidence Map. I saw a tweet today where he asked somebody if their grandma had called and asked about AI yet, well, which I think is him sort of saying exactly what you're saying, Ryan, which is like it's starting to feel a little frothy.
Well, I haven't had that call yet, I guess. People know what I do for a living. I had a lot more calls October 22 from concerned friends. But listen, I mean, I think there's a couple things I like to look at. Advanced decline lines. I've been with you for a while, talking about market breadth. And I know small caps and mid caps have struggled to start this year. But look what they've done the last 2 days. We're starting to see a little more leadership. So if we see less participation, everyone was 99. Like tech was the only thing practically going up in 99. We are seeing various groups going higher. I mean, industrials hitting like all-time highs, consumer discretionary, the list goes on. There's a lot of participation. So Tim, to answer your question, that is what will worry me, and I'm just not seeing a lot of breakdowns in the overall stock market here. There is participation. That's a healthy sign that I'm not worried yet. I don't think this is the final all-time high yet.
All right, so market valuation. So bottom line, what you're saying, Ryan, is that because you're seeing it broadening out, continuing, that's a healthy sign. What about the volume behind it? Broadening out is one thing, but having market participation and volume behind it is another.
Yeah, you're right, Carol. And again, I mean, we haven't had like wild volume, but what you tend to see at extremes is major spikes, whether it be on the peak or, the ultimate lows. And we're not seeing that yet. So to me, I mean, volume matters. There's a lot more volume in options. There's futures, there's these weekly options. So people can get their volume different ways than just simply looking at the NYSE volume, which is what we've obviously looked at for a long time. So, I'm not seeing any major worrisome signs there. One thing, what worries you, right? I mean, we are in February, right? Historically, February is not that great of a month. February in an election year is actually down on average. Oh, and by the way, I mean, we'll see where we close. We're going to have one of the greatest 15-week rallies in the history of the stock market. So we're going to have a major sell-off the next hour or so. And again, that maybe we're just due for a break.
Wait, go back there. We will have one of the greatest. Say that again. We will have one of the greatest
15-week rallies ever. The 15 weeks ago is when we bottomed on October 27th, last year, October 27th last year. And we'll see the final numbers, but we're up significantly, obviously, since then. And, again, that's a stretched rubber band. I mean, I'm not naive to that. We're not naive to that. So maybe you could have some of that early. And one more for you. After 20% rally, February is historically not all that great, and March isn't all that great. So maybe we can have some consolidations, what I'm saying. I'd be open to it.
Okay, let's go back to 5,000 and just what 5,000 actually means, Ryan. For a lot of people, I think it's just a number, but are you arguing that it's more than just a number? It's something psychologically important and it's something technically important for the market?
I'm not so sure technically is the right word to use, but psychologically, yes, Tim. I mean, literally, about 13 months ago, what were we hearing? Recession, bear market. Everybody was talking about it. Our shop wasn't, but a lot of others were. And it's like this reminder that, some of the people who have been the most successful are people that every 2 weeks put money in their 401k, every 1 month just put these things on auto drive and continue to invest. And now they're likely at all-time highs in their portfolios. And this is what we've seen throughout history. So believe me, we all like to time the market and talk about this stuff, and we do it for a living, right? So I'm not minimizing it. But again, I think it's important for more longer-term investors to remember that, hey, when the stock market goes up and down, but they say the stock market's the only place when things go on sale, everyone runs out of the store screaming. I like to use that. And that's what we saw again. We've seen it throughout history. So hopefully investors learn from that. Next time, we're going to have another bear market. It's going to happen. I don't think it's going to happen soon, but that's just something people need to remember.
Broaden it out in terms of technically. You mentioned industrials earlier. You talked about, I think, consumer discretionary. Talk to us a little bit about, too, as you dig deeper into the market internals, what you are seeing on a technical basis, where there is obviously some strength signs, some strong signs, some areas for opportunity, maybe some worry signs also.
Yeah, I mean, we like to look at just relative strength, right? What's a certain sector doing against the overall market? And to keep it simple, I mean, financials, which we all know about some of the issues with financials, but they were like one of the strongest groups second half of last year. So far, the first half of this year, they've hung in there. Industrials also. I mean, Boeing's a big part. Boeing's obviously struggled, yet financials in general have done really well. So there's some clues there that there's a little bit more strength. Now, I'll be very clear. If you look at the number of stocks above their 50-day moving average or 200-day moving average on the S&P 500, it's slowly been trickling lower here. So is that like, kind of some weakness under the surface? It very well could be. Doesn't mean you have to have a major sell-off. And with seasonality and a little bit of frothy excitement coming, it kind of makes sense maybe for a little bit of a break here. Nothing overly over the top. Right here, Carol, that has us extra worried. But again, just some signs that after a record 15-week rally, maybe we just can take a little pause. Wouldn't be the end of the world.
Yeah, well, there hasn't been really a big pause in the last 15 weeks,
No.
Ryan. What would you say to somebody who's been waiting for that pause to put a pile of cash in the market?
Yeah, well, boy, that's a great question there. I mean, listen, if you've been waiting, I guess unfortunately you missed a lot of it. But I mean, I always say when people ask this, do a third, do a third now, a third in a month, and a third in another month, and maybe you'll feel a little bit better about it. But listen, your average year sees a 10% correction on average. When you look at election years, you see double-digit corrections on average. We're probably going to have some volatility here as we get closer to the election, and that can be an opportunity for people that kind of missed a big chunk of. Hopefully, they didn't miss too much of this rally, but if they did miss some of it, I'm sure there's going to be better time to swing the bat coming up here.
Hey, we talked so much about the equity side of things, the technical side of it, and what you are noticing, Ryan. Having said that, how do you layer in maybe what we have been seeing in terms of the fixed income side of things, the U.S. Treasury curve specifically, and expectations about what the Fed may or may not do, and what that fundamentally or technically will mean ultimately for the equity trade as well?
Absolutely. We've been in the camp for a while. The Fed's first cut will probably be in May. We didn't really agree with March, and probably 4 cuts. Because again, the economy is strong, but inflation's coming back. Productivity's high. We really don't need rates where they are as kind of our base case. But we've been underweight equities. I'm sorry, wrong word. We've been underweight bonds, fixed income, for over about a year and a half now. I come on, you saying that overweight stocks. We're still in that camp. But again, when the Fed starts to cut and things, there's still some opportunity in fixed income. But again, we've shortened up the duration a little bit. We're not too crazy about longer term Treasury still. As again, we think the Fed isn't going to cut as much as the market is expecting, but there's always a place for fixed income, a portfolio. Final comment on this, credit spreads, triple B spreads, investment grade corporate spreads. We simply are still not seeing any stress in the credit markets. My opinion. They're some of the smartest people in the room. Until they're stressed, I'm not going to be stressed. Last March, when we had, the 9% correction, regional bank crisis, 16th largest bank literally disappeared. We didn't see much stress in the credit markets then. They were right. We're still not seeing any stress in the credit markets. We're going to follow those.
All right. We're going to leave it on that note. Hey, listen, Ryan, thank you so much. Ryan Detrick, Chief Market Strategist over at the Carson Group, joining us on Zoom from Cincinnati.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, private credit is now the buzziest corner of Wall Street. We know what these are. They're loans that charge floating rates. The Fed's tightening campaign has lenders collecting double-digit yields where they used to get 7%. Carol, by some measures, investors in this kind of credit are earning higher returns than the buyout artists of private equity, and the market is now worth $1.6 trillion and climbing, and BlackRock forecasts it could balloon to a $3.5 trillion market in just 5 years.
So investors are saying, I want a piece of that. It's not so easy to invest in private credit. It's kind of tough if you're not an institutional investor or ultra high net worth individual. Enter Heron Finance. It's a different take on private credit. It's a robo-advisor that allows accredited investors, that's important, those with a net worth over $1 million and highest incomes to invest in private credit. We've got 2 gentlemen who are the co-founders of it, Blake West and Mike Sall, and they join us on Zoom from San Francisco. Guys, it is great to have you here. There's a crypto element to this. I feel like a lot of moving parts. Blake, kick it off for us. Explain how this all works.
Sure. Yeah. So just to talk a little bit about Heron Finance. Heron Finance uses the blockchain to provide just really simple and straightforward access to portfolios of private credit deals. It's the easiest way that anyone's been able to access this asset class, which, as you mentioned, has typically been for institutions. Investors do it to be accredited, but otherwise it's as simple as signing up for heronfinance.com, selecting your risk tolerance, and then portfolios get automatically rebalanced and diversified across many individual deals that, sourced, underwritten, monitored by an in-house credit team that we have.
Okay, so Mike, why does the blockchain need to be part of this? Why do you have to do this on the blockchain? Why include it?
Yeah, what the blockchain is really helping with here is making this into a system that can be interoperable and way more transparent than traditional kind of loans work. And so by interoperable, it's built on the Goldfinch protocol, which is a system that other businesses can build on as well. And then all of the transactions that happen are visible on chain and transparent, so you can see the loans actually being paid back.
And you guys just kicked this off, right, in December, so it's early on in the going. Mike, talk a little bit about that. I mean, what kind of early uptick have you seen in interest among investors?
Yeah, we're seeing a lot of interest basically from a lot of folks who have been thinking about private credit or learning about it and maybe have wanted to participate in private credit funds before, but those are really only open to institutions. So this is really the first time in many ways that investors like this can get access to. So we've just launched and opened it up for investing, and so now folks can start to sign up for it. So yeah, at a high level, it's just been a lot of interest so far.
Well, wait. So we're Bloomberg. We love hard numbers. So you launched in December, if I'm correct, and I think it was, I'm just checking my dates here. So it was kind of early December. So it's been up and running a couple of months?
Well, not quite. We
Okay.
actually opened up for investment only on Tuesday of this week. We
Got it.
announced it in December.
Okay,
And
fair.
so since December, we've been able to have thousands of people sign up on our wait list. And we just, as I said, opened it up for investment a couple of days ago. We've already had a number of investors signing up, and the AUM is slowly coming in.
Hey, Blake, what private credit funds are you investing in? Like, okay, once you do the allocation, that's one thing. But what are the underlying assets? Like if you use a traditional robo-advisor for equities, they're investing in a lot of index funds from, Vanguard and State Street. What are you guys investing in?
Mike,
Yeah, Blake,
we're working with a number of syndicate partners here, basically other credit funds who focus primarily on low and middle market companies throughout the U.S. And the kinds of deals here span a wide range of industry. The goal here is to make it as diversified as possible. So there are a few real estate elements, as well as merchant cash advance companies, as well as an early childhood education center that is part of it. But the general kind of theme is working with these private credit funds that have in the range of 25 to 250 million in AUM that do deals that range between $5 to $10 million for low and middle market companies, primarily in the US, but also in small amounts in international geos.
Why do this?
And all these loans have
Oh, go
collateral
ahead.
and assets backing them or income from the companies.
I'm sorry, say that again, Blake?
I'm just saying all the loans, are backed in some way with collateral, whether that's income of the companies, assets, personal guarantees, et cetera.
That's what I was curious. Like, how are you doing kind of the gut check, the check that where this money is going, investor money ultimately, who are on the platform and tapping it, making sure that these are kind of smart PE bets? Blake, take that.
Yeah, we have a. Yeah, so what our team is doing is working. We have an in-house credit team that works closely with these syndicate partners to evaluate these different borrowers, and it's understanding how is the deal structured, what is the collateral that the borrowers are providing, what are the operations of these companies, what do their financials look like, how do they approach things, what is their profitability, and all these things to make sure that like when we're participating in these loans, they are backed by really high quality companies that have strong business operations across all of these industries.
Hey, Mike, what about fees here? Because when you think robo-advisor, you also think fees being lower, like I'm talking, 20 basis points on top of whatever the index fund that the robo-advisor puts you in. What are your fees?
The fee on Heron Finance is 2% of AUM,
high.
and this compares to, say, a typical private credit fund, which will offer in the range of 1.5% to 2.5% fee, as well as carry above a hurdle rate, typically in the range of 6 to 8% hurdle rate. So it's very frequent that the fees can go to 2.5%, 3% with a typical private credit fund. But what we're trying to do is bring those fees down over time compared to those kind of options.
So is the fee only on AUM, Mike, or is there also carry included?
There's no carry. It's just a straight AUM 2% fee.
I want to go back to, what is the appeal to investors specifically and borrowers? I mean, a private credit in crypto form. Why not, Blake, just use dollars, US dollars?
So dollars certainly are possible. People have been doing trillions of dollars of private credit using just dollars. But we see with crypto is, Mike was kind of alluding to before, a few key benefits here. One is there's lower cost to send money around the world, which is especially valuable if and when we start taking international investors. But also the transparency is really unprecedented. So as an investor, when we send money back into your portfolio, you can see those payments on chain, and you can verify that cash is actually sitting there. We're not just telling you that. And then a little bit more broadly, crypto has the ability to create an interoperable financial system. So, we can be building on the Goldfinch protocol, but another company could also build on the Goldfinch protocol. Those loans can interoperate. We can also, for instance, there's other crypto companies who want to be building things like borrow-lend protocols against the positions that Heron Finance has. So an investor could, for example, then, borrow against their position without having to liquidate that position. And that can all happen in a much more interoperable and seamless way on chain with that transparency that really can't be beat.
Mike, I want to bring you back into this. I mean, there are so many still legal and regulatory questions swirling around crypto. Even when, the spot Bitcoin ETF was approved, Gary Gensler is still out with a list of risks and still not all in. Are there, Mike, any regulatory issues that are top of mind for you guys that you have to be on top of and worry about?
Well, Heron Finance has registered with the SEC as a robo-advisor here, and so we've taken a lot of efforts to be highly compliant, fully compliant with all of the requirements that go along with that. That includes involving a qualified custodian as part of what we do, building up a deep compliance function internally, making sure that we're providing appropriate disclosures and helping people understand all of the risks that go into investing in products like this. And so I view it as we are doing all the things that any kind of registered investment advisor needs to do. And what crypto is helping us do here is handle all of these kind of payments and the rails under the hood and provide that transparency, which is still just a net benefit to our investors. And so, I'm sorry, what?
No, please finish.
Oh, yeah, so compliance is super important, and we are registered with the SEC, and we have this fiduciary responsibility now to handle our clients' objectives in the right way.
Blake, you mentioned AUM. You guys just started. Is there a thought in terms of AUM by the end of the year? What are you guys hoping for in terms of uptick or your expectations? And just got about 30 seconds.
Yeah, I'd say we're hoping to get at least into the $25 to $50 million range by the end of the year.
All right.
Yeah, it's interesting. The interest that you guys are seeing, is it U.S. investors, outside the U.S.? Just quickly, Blake, take that one.
Yeah, all U.S. investors right now, we're only open to U.S. accredited, but we plan to open up to international as soon as we can.
Really interesting. Guys, come back. Let us know when you get into this, and as the months tick by. I'd love to hear how things are moving along. Blake West, Mike Sall, co-founders of Heron Finance, joining us on Zoom from San Francisco.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just about 18 minutes left in today's trading session. As we've been saying throughout the day, the S&P 500 is on track to finish above 5,000 for the first time ever today, briefly breaching that threshold late yesterday. But we, as Charlie just mentioned, 5,023 on the S&P 500, just up about 0.5% though. But you've been pointing out, Tim, throughout the day, NASDAQ really the outperformer, up about 1.2% here.
Yeah, let's get some thoughts from Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. He joins us from Chicago for our Drive to the Close this afternoon. Good to have you with us, Andrew. What do you make of 5,000? Is it just a number, or is it something more meaningful?
Well, I think it's important to consider that the market traded below its January 2022 high for 2 years. We hit 47.96 in January of 2022. And it took until January of this year to break through that number. So that's a lot of kind of energy that built up. It's kind of holding the beach ball underwater. It finally broke above that. And as you let go of the beach ball underwater, there's some energy. So it doesn't surprise me that we quickly ran from 47.96 to 5,000. and we're getting follow through because inevitably, and I know this is crazy to believe, but investors, once they start readjusting their high water mark on their portfolios, they become more optimistic, not less. So I think this could continue, but the market's clearly overbought short term, and I suspect in the next couple of weeks it will run out of steam.
Yeah, I mean, you've got a NASDAQ that's already up about, 5% so far this year. You've got a NASDAQ 100, that was an S&P, forgive me, up about 5%, 6%, almost 7% on the NASDAQ 100. And I was just going to do, we were talking earlier with Ryan Detrick, who looks at market technicals. If I look at an RSI on the S&P 500, no doubt about it, we're overbought. Having said that, I don't know. Can you yet get a feel of how this year might play out when you think about earnings, fundamentals, maybe what the Fed might ultimately do, or there's still too many questions out there for you to kind of make that longer term bet?
Yeah, I mean, look, first of all, don't lose, not that you have, but don't lose sight of the fact that the earnings reports for the fourth quarter were very strong. So this is not just a speculative run in the market that some of the bears want you to believe. It is being supported by some excellent earnings reports and positive earnings revisions. And I am a believer that this will be another good year for equities for the simple reason that investors were underweight equities last year. And that is consistent with the first year off a bear market low. Unfortunately, investors looking in the rearview mirror, they don't turn bullish when things are low, they get more bearish. It's in the second year that you start to see money come back into the market from retail investors, and that's what is now happening. It started in November, took a pause the first couple of weeks in January, it's coming back. So I think that is classically the fuel for the second leg of the rally, which will be this year. The however is, unfortunately, the second year is more volatile than the first year. Think about last year. Market went up 8 out of 12 months. It never gave those who were underinvested an opportunity to get back in. Second year tends to be more volatile. So I think there's, it's not going to be as easy this year, but I do think it will be another good year.
Which makes me also wonder, February 1, we got to read money market fund assets reached $6 trillion for the first time. Everybody points to, okay, all this money that could come rushing in. I am curious when we get to the next reading, March 1st, whether or not we start to see some of that money trickling out. What are you guys seeing on your end in terms of where flows are still going or not going?
Well, yeah, I think you're right. The money is still coming into the money market, but we see flow. I'm an equity manager, and I see the flows have turned. And it's it's just so fascinating. Nothing really changes. If you go back to 2020, the year 2020, the market bottomed in March, and flows didn't turn positive until February of 2021. If you go back to the low of 2009, which was in February of 2009, flows did not turn positive till the spring of 2010. So my point of this is that now that low was October 2022, it is consistent that money will start to trickle back into equities. But I suspect that it won't really accelerate until you start to see Fed cuts where the attractiveness of money markets start to wane. But to say the money won't come back is to say that people will stay rational and they won't get greedy. And I think, you get 4% or 5%, but that's a full year. And that's, equities are already up 5%.
Where do you
year, and it's not a full year yet.
Where, Andrew, do money market rates have to go? How low do they have to go in order for people to say, okay, this is no longer worth it?
That is, please, if you could tell me the perfect answer for that, that's the key question. And the data suggests, you really need, few Fed cuts where you get rates down into the 3 to 4% range before the money starts to loosen up. That's kind of the history, and I think so. That tells me that you're looking at later this year for another surge in flows into equities. But there's no doubt now. You're starting to see the fund flows have turned positive. Last week, the numbers were very, very positive, and I think that's why you're seeing, as much as everyone's focused on the Mag 7 or the Super 6 or whatever the number, that's why you're starting to see more of a broadening out, because as money's coming back in the market, people look for things to buy that maybe they can justify the valuation, wrap their head around, and not just buy the all-time high list.
On that Mag 7, if you will, you still like Microsoft, right?
That's right. I mean, look, I know it's done well. Very well. I know it's not cheap, but if you look at the numbers, the estimates for the success of Copilot this year, there's a lot of uncertainty, and they're relatively low. And I think it's going to end up being absorbed by users much more quickly than the caution with which Wall Street's embracing that. And maybe stocks starting to reflect that, but I think that's really going to be the story.
Yeah, it looks like the stock had another record today on an intraday basis. I mean, I'm looking at Microsoft up almost 12% so far here in 2024. Hey, Andrew, thank you so much. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, joining us on Zoom from Chicago.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.